Chapter 7, Wheel of Incorporation we have covered. LLP we have covered. Difference between partnership and companies we have covered. Let's move towards another topic called types of companies. There are mainly two types of companies, public company and private company. Public limited company or private limited companies. Public limited companies are those companies who can sell their shares, who can offer their shares to the general public. While private companies' shares cannot be sold in general public, there are few private investors who are holding shares. They can find any of their known person to sell shares, but they cannot offer to sell company shares in general public. Mean public company can offer shares to general public, mean their shares can be sold on stock exchange. And public companies are limited by shares, mean owners liability is limited up to the amount of shares. Public companies need to include PLC with their name, while private companies need to include PVT with their name. Mean with the name they can be identified. PLC mean this is a public company. PVT or PVT Limited, this is private limited company. LTD or PVT Ltd. Private companies are further divided into limited by shares and unlimited. Limited by shares mean owner's investment is limited up to the amount of shares. Unlimited mean their liability will be unlimited, but they do not need to file accounts. This is like partnership. Private limited companies are of two types by share, mean liability is limited up to the amount of investment of the owners, are limited by guarantee. Limited by guarantee. Means sometime owners declare my liability will be maximum up to say $1 million. This is limited by guarantee. Mean they are giving guarantee. Okay, I will pay more than my investment, but up to how much? Maximum 1 million. So limited by guarantee offer for, and this is normally for a not for profit organization. In case of losses, the members who are running the organization who have formed this private limited company, their liability is maximum up to how much amount they guaranteed that they define at start. So liability is of members limited to amount agreed to be contributed. So public can sell shares in stock markets to general public, and liability is limited up to the amount of investment. And they need to include PLC with their name. Private, those who cannot sell shares to general public, their shares are in the hands of a few private members, and they need to include PVT Ltd or simple Ltd with their name. And private, limited by shares are limited by guarantee. Limited by guarantee mean members have stated a amount, maximum amount up to how much they will pay against liabilities. And private could be unlimited like partnership. Private company versus a public limited company. Public company is registered as a public company, and any company that is not registered as a public company will be called private company. Public company need to include PLC with their name. PLC stands for public limited company, while private company need to include PVT Ltd or simple Ltd with their name. Ltd stands for limited. For public company, in order to trade, must have allotted shares of at least 50,000 pounds, mean their share capital must at least be 50,000, then they will be able to start a trade. Of which at least 1/4 of the nominal value should be paid up. Means sometimes company issue shares and shareholder do not pay full amount of the shares. Whatever they paid, that is paid up. Whatever is not paid, still company need to recover from shareholder. That is called unpaid up capital. So their share capital must at least be 50,000, and out of this, 1/4 mean 12,500 must be paid up share capital. Then they will be able to start a trade. Without meeting this condition, if they are trading, that will be considered illegal. While for private company, there is no minimum or maximum requirement of share capital or paid up share capital. They can start a trade anytime. Public companies raising capital may raise capital mean money by advertising its security. Security means shares or debenture if company is moving towards raising money through debt. As available for public subscription, mean they can advertise their issue of shares and debenture into the public. While private companies are prohibited from offering its shares to the public, they cannot offer shares to general public. Public companies start of trading must obtain trading certificate from registrar before commencing trade. Mean without having trading certificate, they cannot start a trading. While private company can become from the date of incorporation, whenever the company is incorporated, they can start a trade. They don't need to require trade certificate. For public company, it is compulsory they should have at least two directors. More better, but at least two. But for private company, minimum one director is required, at least one director. For public company, they must have one secretary who must be qualified secretary, while for private, there is no need for secretary. Public company must file accounts within 6 months, while private company need not lay accounts before general meetings, must file within 9 months. General meetings are compulsory for public but not for private. Public audit is compulsory. Audit of financial statement is compulsory for public company, while for private audit not required if meet exemption criteria. Mean certain limits they are not required for audit. Public company must held every year AGM annual general meeting where they should call all the shareholder to present annual reports of the company. While for private company, there is no need for calling AGM. Public company cannot pass a written resolution. A resolution should be approved from the shareholder at AGM. While private company, they can pass written resolution, mean they can define their rules and they can change their rules and while for public, no, they need consent of shareholders. What is unlimited company? Unlimited company, where the liability is unlimited. An unlimited company is a separate legal entity and it has assets. It will have the benefits arising from separate legal personality. However, if one company's assets are insufficient to meet its liability, all members are liable to contribute without limit towards paying its debt and the cost of liquidation. Such companies do have the advantage that they need not have their accounts audited and need not deliver annual copies to the registrar of companies. In some countries, it is allowed. Community interest companies that are created not for profit, companies created for benefit of the community, means social welfare. Since 2004, it has been possible to form a community interest company for those wishing to establish a social enterprises. The company's object must be considered by a reasonable person to be of benefit to the community, and any surpluses mean they don't calculate profit and loss, they calculate income and expenditure account. Either income are more than expenditure, they will be having surplus. Income are lesser than expenditure, they will be having deficit. So any surplus mean profit, more income than expenditure made by the company should be reinvested for the purpose of the company, mean members will not withdraw any money. The money they spend on the better of community. And if there is any surplus, that will be reinvested into the business. Mean members cannot withdraw any money because this company is mainly established for social welfare, not charity, not for profit organization. Such a company must first be registered as a company limited by guarantee or as a company limited by shares and then apply the regulator of community interest companies for community interest company status. Regulator of community interest companies. These companies may be used as vehicle means separate entity for community interest such as a local crime prevention group. The company name must end with CIC, stands for Community Interest Company. Small companies and micro entities. A company will be small if it meets any two of the following criteria. Its turnover of 10.2 million pound or less will be called small company. 5.1 million pound or less of net assets on its balance sheet. Our employees are 50 or less. That company will be called small company if it is meeting any two of these criteria. When its turnover means sale is up to 10.2 million, not above that. Its total assets are up to 5.1 million pound, not more than that. Or its employee are up to 50, not more than that. That company will be called small company. If a company is a small, it can use the exemption to not have its account audited, mean they are exempted from audit. This means audit is compulsory for those companies who are having revenue above 10.2 million pound, are asset above 5.5 million pound, are having more than 50 employees. It can also choose whether or not send a copy of director's report and profit and loss account to company's house and submit abridged accounts. Abridged means combined accounts. The company will be a micro entity, is smaller than small company. If it meets any two of the following criteria, turnover of 632,000 or less, even below 1 million, 632,000 pound or less. Net assets in balance sheet are of 316,000 or less. Or employees up to 10. That will be called micro company. Up to 10 employees, 316,000 or less asset, and 632,000 or less revenue, sales. If a company is a micro entity, It can prepare simpler accounts than those required by statutory minimum requirement and choose to send only a balance sheet with less information to company's house. It can also benefit for the exemption available to small companies, mean audit is not compulsory for them. Test your understanding too. Which one of the following statement is incorrect in relation to a public company limited by shares? Incorrect. The company must have at least one director. Limited by shares must have two directors. This is incorrect. The company must have a qualified company secretary. Yes. A company must have an allotted share capital of at least 50,000. Yes. The company must be registered as a public limited company. Yes, this is wrong. Number two, try by yourself, please. See, the allocated share capital now, this is for PLC, must have at least more than 50 member. This is for PLC. The liability of its member must be limited PLC. Who are promoters? Promoters are the people who promote company shares, who help the company to issue its initial shares. I mean, when company is going to be formed for the first time, company need to offer its shares through whom? Through promoters. Could be different banks who convince the public to buy company shares. So there is no statutory definition of promoters. According to case law, a promoter is a person who undertakes to form a company, mean they are helping to form a company, and who takes the necessary steps to accomplish that purpose. Mean helping to form the company as well as issuing its shares. The definition excludes people just acting in a professional capacity, such as accountants or solicitors. Mean accountants, solicitors are not promoters. What are the duties of promoters? A promoter is under a fiduciary duty to disclose any interest and transaction to the company and not to make a secret profit. If he is taking any secret profit while performing business activities, he need to disclose. Disclose any benefit acquired to an independent board and or to the shareholder. If a promoter does make a secret profit, the company may resign the contract with the promoter. Resign means cancel. But this is not always possible. For example, if a third party has acquired right under the contract, obtain damages, but this requires the company to prove loss. Recover the profit, the company must prove that the promoter has failed to disclose the profit from a transaction. So promoter have to disclose any secret profit. They have to disclose any benefit achieved to the board as well as shareholder. But if he is not performing his fiduciary duty, company can resign the contract, company can claim damages or recover the profit that he haven't disclosed. And there is a case, Erlanger versus New Sombrero Phosphates Company, E versus NSP. E bought the lease of an island for company mining for 55,000. He then set up the new company. 8 days after incorporation, he sold the island to the company for 110,000. When he was asked to buy an island for the company before company incorporation. So before incorporation, he bought the island for 55,000. And then after incorporation of the company, he sold to the company for 110,000, meaning he charged to the company 110,000. This means there is some benefit. Though through a nominee, after 8 months, public investor found out the fact that E had bought the island at half the price the company has paid for it. The company sued to rescind the contract and recover its money. The court decided the contract could be rescinded. The promoter of a company stand in a fiduciary relationship to investor, meaning they have a duty to disclose. Pre-incorporation contracts mean if before incorporation of the company, he signed any contract with any of the third party, who will be responsible? He himself, not a company. A pre-incorporation contract, pre mean before company incorporation. A pre-incorporation contract is where a person enters into a contract before a company has been registered. The position at a common law is that a company prior to its incorporation does not have contractual capacity, and after its formation, it cannot ratify or formally adopt a pre-incorporation contract. Ratify me? Accept. The promoter is therefore personally liable under any such a contract. This is because a company does not legally exist until it is incorporated. And there is a case, Kalner versus Baxter. A, B, and C entered into a contract with the claimant to purchase goods on behalf of the proposed GRA hotel company. So A, B, and C enter into a contract with the claimant to purchase goods on behalf of the proposed GRA hotel company. The goods were supplied and used in the business. Shortly after incorporation, the company collapsed. As the GRA hotel company was not in existence when the contract was made, it was not bound by the contract and could not be sued for the price of the goods. Neither could it ratify the contract after incorporation. I mean, who is responsible for that? With whom A, B, and C having a contract. Section 51 of Companies Act 2006 reinforces the common law position by providing that subject to any agreement to the contrary, the person making the contract is personally liable. Clear and express words are needed in order to negate liability. I mean, if promoter has signed a contract with the company, being a promoter, if there will be any liability on me, that will be liability on the company. Then company will be liable. Otherwise, all pre-incorporation contract, who is liable? Promoter. The promoter can protect their position by including a term in the contract, giving the company the right to sue under the contract. In his contract with the company, if he has included a term, in case of any future liability on me, company will be liable. Then company will be liable. Postponing finalizing contract until the company is formed. Mean the contract with A, B, and C, he could postpone until that hotel company formed. Then hotel company could be liable. Entering into an agreement of novation. This involves discharging the original contract and replacing it with a new one or assigning, transferring the contract. All parties must agree. Mean if any contract was made before company incorporation, so after incorporation, he can transfer that contract to the company. In that case, promoter can discharge himself from liability. But he haven't transferred to the company after incorporation, that he will be liable. Agreeing with the company that there is no personal liability for the promoters. In that case, company will be liable. Buying an off-the-shelf company. So it is ready to contract without waiting for incorporation. Off-the-shelf means already established company. If he is a promoter of already established company, then whatever the contract he is having with third party, who will be liable? Company, because that company is already established. So what is off-the-shelf company? An off-the-shelf company is one that has already been formed. Buying off the shelf has a number of advantages. It is cheaper and simple because you don't need to bear the registration cost of the company. You don't need to prepare documents for registration of the company. Can trade immediately. You don't need to wait for trade certificate. And no problem of pre-incorporation contract, and there will be no pre-incorporation contract. MCQ number 1. Company can always sue the promoter for damages. The company can only resign the contract with the promoters when the promoter owned the property before the promotion began. The company can always resign the contract with the promoter. The company can only resign the contract with the promoter when the promoter acquired the property after the promotion began. D. Number 2. Which of the following are correct? Purchasing an off-the-shelf company enable a business to commence more quickly. Yes. Quick, simple. It is generally cheaper to purchase an off-the-shelf company than to arrange for a solicitor or accountant to register a new company. Yes. Incorporating a company by registration enable the company's documents to be drafted to the public need of the incorporators. Incorporating a company by registration enable the company's documents to be drafted. We don't need to draft documents for registration purpose. So all are correct. Number 3. A company's contractual capacity before incorporation is limited in that it may only make a contract necessary to form the company, only ratify once formed contracts necessary to form the company, only make or ratify once formed contracts necessary to form the company, not make or ratify once formed any contract even if necessary to form the company. A company's contractual capacity before incorporation is limited in that it may only make contracts necessary to form the company. And next topic, registration, how company can be registered. First, there should be application for registration, and then there should be memorandum of association. First, company need to put an application for registration. Section 9 of Companies Act 2006 sets out that information that must be delivered to the registrar when an application for registration is made. In all cases, the application form must include the proposed name of the company, proposed that registrar will see if it acceptable, that will be finalized. Whether the member will have a limited liability by shares or guarantee. Whether the company is to be private or public, and details of the registered office mean where company will be situated. And after that, they need to prepare memorandum of association. Memorandum of association, MOA, is like prospects of the company. Mean having all the information related to company. Used to be a more important document under previous company legislation, signed by all subscribers. First shareholder are called subscribers, and stating that they wish to form a company and agree to become members of the company mean they need to provide their consent agreement. In relation to a company limited by shares, the memorandum provide evidence of members' agreement to take at least one share each in the company. So if they are shareholder, they must be having at least one shares. Is not possible to amend or update the memorandum of company formed under Companies Act 2006. It is not possible to amend or update the memorandum of the company formed under Companies Act, because those things will be fixed. And after that, documents to be sent with application. Mean with the application, what documents they need to send? Statement of capital and initial shareholding. In fact, PLC, 50,000 pound, and paid up should be 1/4. Essentially, in a snapshot of a company's share capital at the point of registration, this must state the total number of shares to be taken by the subscribers to the memorandum, their aggregate nominal value, and market value mean premium plus premium, the class of shares and the rights which attach to them, the aggregate amount unpaid on the total number of shares, and a contract address for each subscriber mean initial shareholder. Or statement of guarantee. In case of limited by guarantee, this states the maximum amount each member guarantees to contribute in case of winding up. In case of share, don't need to mention maximum amount, but if a company is registered, going to be registered as a limited by guarantee, then every member have to state the maximum amount that they will be liable to pay. Statement of consent to act. The company confirms that the director or secretary has given their consent to act mean run the business. Statement of compliance. This provide confirmation that Company Act has been complied with. Mean we will run the company as per Company Act. It may be made in paper or electronic. And registration fee currently 20 pound approximately for submitting application. Note as the model article will also apply, mean company need to prepare article of association as well. AOA stands for article of association, mean company policies. Document is called AOA, article of association. Company need to submit it as well. but it is not mandatory. If company is not submitting it, there is a model article association that is already defined by Companies Act. So that will be upheld. So as the model article will apply if no articles are supplied, it is not a requirement that article must be sent, although all companies will have articles, either their own adopted, defined, or model. The streamlined company registration service, which was set up as a collaboration between Companies House and HMRC, Taxation Authority in UK, allows for new business to register their company and also register for tax at the same time. The purpose of the service is to make it easier for new business to fulfill their legal obligations by registering with the Companies House and HMRC in one go and dispense with the requirement to send duplicate information to both. I mean, they need to submit all the documents to Companies House as well as HMRC. Registrar, to whom company need to submit application and documents. What are his duties? On receipt of the above documents, the registrar must inspect the documents and ensure that Companies Act requirements are fulfilled. Issue certificate of incorporation, which is conclusive evidence that Company Act requirement have been fulfilled. The company may exist from the date of the certificate of incorporation, not the registration date. No. Trading certificate is a certificate. By having that, company can start a trade. A PLC cannot commence a trade until registrar has issued a trading certificate. In order to obtain trading certificate, an application must be made to the registrar which state the nominal value of allotted share capital is equal to or less than 50,000. No, less than, greater than or equal to 50,000. Mean at least 50,000. At least a quarter of the nominal value and all of the premium have been paid up, mean one fourth, 12,500 should be a paid up capital. The amount of preliminary expenses and who has paid or is to pay them. Mean in registration of the company, what are the preliminary expenses? Any benefits given to are be given to the promoters. If it trades before the certificate is issued, the company and any officer in default are liable to fine if company is trading without trade certificate. It is criminal offense to carry on business, but any contract are still binding on the company with third party. Any transactions are valid. However, if the company failed to comply with its obligation within 21 days after being called upon to do so, the directors become jointly and severely liable for those obligations. It is a ground for winding up if not obtained within 1 year. The company will be forced to wind up operations if they haven't obtained trade certificate within 1 year of incorporation. MCQ number 6. Bob and Mike decided to form a company on 1st March. They sent the necessary document to the registrar on 10th May. They received the certificate of incorporation dated 1st May 2006. Company is incorporated at 1st May 2006. Subsequently, they discovered that the company was registered on 1st June. What was the date of incorporation? First, whatever when the company was registered. Which of the following documents need not be submitted to registrar a company limited by shares? A company memorandum association must. Statement of consent to act must. Statutory declaration of compliance must. This is not mandatory. If it is submitted, fine. Otherwise, model article. Name of the company. How company name can be chosen or decided. There are certain guidelines. The name of company must comply with the following rules. It must have a Ltd or PLC at the end. It cannot be the same as another in the index of names. It should not be already existing company name. It cannot use certain words which are illegal or offensive. It must have the Secretary of State consent to use certain words. For example, England, Chartered, Royal, National, University, Insurance. These words cannot be used because these words are associated with state organization. Or any name suggesting a connection with the government or any local authority. It must avoid the thought of passing off. What was thought of passing off? Giving harm to any other party. Civil claim. The Secretary of State can force a company to change its name in the following circumstances. The name is the same as or too like to an existing registered company. Within 12 months, you need to change the name. The name gives us so misleading an indication of the nature of the company's activities to be likely cause harm to the public that you need to change immediately. Misleading information or undertaking were given when applying for name that required approval. Within 5 years, you need to change. Companies Act 2006 allow a company to change its name by special resolution. Special resolution. 75% majority shareholder voting. As discussed at the end of chapter 3, if a company feels that another company has a name which is too similar to its own, it may object to the company name's adjudicators. MCQ number 1. Which of the following name could not, without further consent, be a permissible name under the Companies Act for a company, the main object of which is to contract refuse collection service for Westminster City Council? Refuse, the main object of which is to contract refuse collection services for Westminster City Council. Westminster City Refuse Services Limited, they can use. Council Refuse Collection Services Limited, council mean the government institute in UK are called council. Refuse Collection Westminster Limited, City Waste Disposal Limited. So this they cannot use. Because it is giving a resemblance like this is a state-owned organization, council. Which of the following statement is correct? It is not possible to register a company limited by shares with the same name as a company already on the register. Yes. Once on the register, a company limited by shares cannot change its registered office. Company can change their registered office. So which option is correct? Only one. Number three, a business has been registered under the name the Mark Jones Partnership Company Limited. What type of business organization must this be? Partnership, private limited company, public limited company, any of the above. Whatever is the name. What is at the end of the company? LTD. That's it for today.